Hi guys, this is Craig, the options linebacker. This is the weekend report for Sunday, May 8th. I'm going to spend the majority of my time on this report on the S&P 500. Before I get to the S&P though, I want to look at some various index charts to make sure that the S&P is not off on itself. First of all, I'm looking at Dow theory here with the Dow Jones Industrials on the left, the transports on the right. We use these two in a pair to look for Dow theory confirmation. And both of them are actually making higher highs and still, at this point, higher lows. We still haven't violated the lows, at least on a closing basis. So that's certainly the case in the transports here. Higher highs, higher lows. We're still in a bull market on Dow theory. So now let's look at some other sectors. We'll look at technology with the NASDAQ on the left here. We'll look at the small caps with the Russell 2000 on the right. Again, the same deal. We're making higher highs, higher lows, higher highs, and higher lows. So regardless of the fact that everybody is scared half to death based on what happened on Thursday and Friday this week, we're still in an uptrend on these charts. So now let's look at the S&P 500. We'll start that with a monthly and weekly chart. On the monthly chart on the left-hand side here, we went from a higher high to a lower low, and we knew at some point after this bear market that we had from 2007 to 2009, we'd have a good strong rally leg up off of here, but we'd make a lower high at some point. So in other words, this is what it looks like. We go from a higher high to a lower low. At some point, we're going to make a lower high. Now that could have happened at the 38% or the 50% or even as high as the 61.8. And that's what it looks like it took, was it took about the 61.8% retracement for this chart to take a pause here. So again, this is all very normal for this to put in a lower high, because what happens after that is obviously important, because if that lower high then becomes a higher low, then we have the next rally leg. Otherwise, that lower high just turns into from a higher high to a lower high, and we're working our way down. So obviously, this is going to be very important what happens over the next couple of months at this point, but this is all still very, very normal regardless of which way it's going to go. Now looking at the weekly chart on the right-hand side here, we can see that we have a nice wave structure, wave 1, wave 2, wave 3, wave 4, wave 5. Wave 5 is usually the finishing or the exhaustion wave, and then what happens after this is that we could either start heading down from here, putting in another 5-wave series, okay, if we're going to roll over into a bear market, which I think is still premature. Or we also could head up to a 5-wave series, and then we just do an ABC correction down here. Now I'd also like to stress that it'd be normal for this to pull down to the 38%, which is around 1,009 on the S&P, or the 50%, which is around 943, or even down to the 61.8% retracement at 878, and this would still be a normal reaction in a bull market, which we've been for the past year and a bit. So based on this, I still think the most likely outcome is this ABC structure in the near term, probably the next month or so. Now let's go into the daily chart on the S&P 500. There's a few interesting things to see here. First of all, the price is well outside the Bollinger Bands. That usually means that the price has come too far too fast and will revert to the mean to go back inside the bands here, usually within the next day or two. And we can also see what we've been talking about here for months. We've had bearish divergences, swing-based bearish divergences on the MACDs, which are a strong signal, but as I talked about a few weeks ago, these tend to go on and on and on, and you lose patience looking for the actual signal. So you can't trade off of these MACD divergence signals. All you do is you put them on the pile of evidence that shows you which way things are likely to break next. Okay, so if it looks like in the short term we may see some kind of bounce back up here, what type of structure are we going to see over the next 2, 3, 4, 5 weeks or so? Well, to answer that question, let's go back into time and see how we've handled other types of these crash scenarios before. Now, first of all, let's look at the 1987 crash. We had a pretty big crash here, a 34% crash, and it looks like at least 2/3 of that was on one specific day. So what can we learn from looking at this chart from a long time ago? Is it almost 23 years? So what we can tell is that the low of the move was generated when the most emotion was there. So that's number one. So we didn't get a lower low after this. So the crash really marks the important pivotal low on the move. So that's number one. Number two, we did get a pullback up to a fib level. In this case, we got a pullback to about the 38.2% level before the bottom was retested again. So number two is we get a fib pullback, and then number three is we'll retest the bottom again. So that's kind of the structure that we're seeing on these types of moves, is that after this move, after you get a retest of the bottom, a double bottom, or perhaps even a slight undercut, that's when things start to stabilize. Now the next example is from 1998. This wasn't technically a crash, but it was a very, very strong correction in a very strong bull market. So we had kind of a wave-based structure here. This wasn't a crash by itself, it was just the initial wave down, but the real emotional move was right here where we just plummeted about 10%, 10 to 12% in just about 3 days. So that was real strong, not quite a crash, but close to it. So again, what I want you to notice here is that the emotional move really marked the low for the level here. So the low level was marked by that emotional move. And in this case, it took about a month of working its way higher, in this case to the 50% fib, before it rolled over and retested that low. And the low retest was just an intraday undercut, nice hammer candlestick, and then of course we know what happened here. We had a very strong bull market for about the next year and a half. So let's take those lessons back to today's chart. So we can see that we've had a very, very emotional move, which was on Thursday. Friday wasn't all that strong either, but it was definitely an inside day. Didn't go below Thursday's low. So we've got our emotional low marked out for the market right now, which is right around the 1060 area. And the fibs are marked here. This is the fib retracements at 38.2, 50%, and 61.8%. So what we're saying here is very likely we'll go as high as about 1160 at the highest on the bounce back up, which we will get a bounce up sooner or later, perhaps this week. And then we'll probably see the rally stall at that point, and we'll have some type of a retest of the bottom. Sometimes it'll come down to match that bottom, sometimes it'll undercut, sometimes it won't quite hit as low as before. But in either case, this bottom will get retested before we really start to move higher again. Now, if we retest the bottom where we just blow through it on the way down, then we have more serious problems, but I just don't see that happening just yet. Now, there's also a couple of different ways this can happen. You can see that the price is already retraced up to, on Friday, the 38.2% retracement. If it stays around this level like it did in 1987, notice how that one took a while before it really rolled over and retested the bottom. Okay, that's one way to do it. The other way to do it, we have an extremely strong snapback rally, goes immediately up to that 61.8% fib. We'll probably see some resistance come in up there. So the stronger that it bounces back, we may see a stronger move back down. So you can kind of see how this maps out. This wasn't a real crash per se back in 2007 in February and March, but you can see how the wave structure here maps out really nicely. We had an emotional move lower, a move back up here, in this case to about the 38.2% fib, and then a move straight down, an undercut, and then an extremely strong snapback rally after that. So keep your head on straight, folks. Good trading this week, and we'll catch you next week.